Hey, welcome to a Will Night podcast all about nothing. Today we are diving into the world of IRAs. Whether you're just starting out or looking to maximize your savings, understanding IRAs is essential for building wealth. Joining us today to explore that is,
Hey, my name is Bryant Taylor.
and he is the co-host for today. Hey, Brian, how you doing?
I'm doing pretty good. Thanks for having me.
No problem. Brian is also my financial advisor, and he's treated me very well over the years.
Thank you, Will.
And we're going to talk to him just basically about some IRA stuff. So, got a list of questions, Brian, for you, and we're just going to start off. For people who are just getting started, what exactly is an IRA?
An IRA is kind of like the government's way to incentivize you to save for retirement. You have so many options when you save. You can save in your bank account. You can save in like a regular brokerage account, they call it, like a non-retirement regular investment account, but you got to pay taxes every year. But if you use an IRA, there's IRA and Roth, which I'm sure we'll get to. An IRA has some extra tax benefits, so the government's kind of saying, hey, we want you to be able to retire with confidence. We want you to save some money, so we're willing to give you some tax benefits while you do it that might help enhance your returns or give you a little bit extra tax savviness, if you will. So you can choose IRAs or Roth, but it's really like a government program that allows you to save with extra tax benefits.
Okay. What's the difference between an IRA, or I'm sorry, what's the difference between a traditional IRA and a Roth IRA?
So a traditional IRA has been around for the longest time. It's been around forever. That's where they started with it. A traditional IRA, by the way, the same conversation goes if you have a 401k, if you got a 403b or deferred comp, 457. Unless you hear the word Roth, this kind of applies to all retirement accounts that you have at work. But an IRA is basically, let's pretend your income is $100,000 and you're willing to save $5,000, let's call it. So you make $100,000 and normally your whole income is fully taxed. You got to pay federal, state, all the other taxes. But if you throw $5,000 in an IRA, then your income goes from $100,000 to $95,000. So you're basically saying, hey, can I save some taxes right now? I need help today. My income is high. So it gives you some tax relief today in the current tax environment. But then that money goes in, and then it's growing. Whatever investments you chose, you can invest in like whatever you want in an IRA, pretty much, by the way. But as that money grows, 10,000 growing for what do they say? Every 10 years it can double at 7%. So in 10 years, the 10,000 turns into 20. 10 more years, it turns into 40. 10 more years, it turns into 80. It's growing pretty fast over a period of time, compound interest, right? But that whole bucket has never been taxed. Remember, you got a tax break. So now the entire bucket, as you pull it out, no one's gonna take it out in like one clean swoop. It has to last you your whole life, your whole retirement. You're going to be retired for 20 to 40 years, hopefully. So you're taking out small bite-sized chunks. But when that money comes out, it gets taxed then. And it all depends on how much income you're making at that time. Do you have rental income? Or you have Social Security? You got part-time job? You got pension? You add it all up. And then it's also dependent on whatever tax rates are at that time. Today, we know what tax rates are, but no one has any idea what taxes are going to be in the future, right?
Correct. Or every 5 years, the tax rate always goes up or down.
Exactly.
Depending on your income status.
100%. So it's really impossible to perfect, the decision, do you go pre-tax or Roth? It's kind of like a game. But I'll tell you over the course of this call probably that I'm a big fan of Roth for most people, but there are times when I think pre-tax does make a lot of sense. It all depends on your situation, of course, right? But pre-tax, yeah, you take the tax break up front, and then every single thing in that account is fully taxable as you take it at the tax rates that are present at the time you take it, right? And by the way, we have a $38 trillion debt and counting, and we live in Illinois, right, Will? So Illinois has one of the worst budget issues in the country, probably one of the worst states. And luckily, they don't tax IRAs. We're one of 13 states that don't tax IRAs.
Really?
A lot of other states do. But if we have one of the worst budgets and one of the worst balance sheets of all the states, that's like one of the easiest low-hanging fruits that they could start taxing IRAs and pensions, but now they don't.
Okay.
So that's pre-tax, but then Roth, because I think you asked, what's the difference?
Yes.
So Roth, I'm such a big fan of Roth. Roth money doesn't give you any tax breaks today. So you put money in, let's say you make 100 grand again, you put 5,000 in, it doesn't give you any tax breaks at all today. You still pay full taxes on the 100 grand. But that 10 grand goes in, in my example you started with $10,000 and it just grows over 40 years and it quadruples. Well, in the Roth world, all of the growth that you ever received the entire time, as long as you don't touch these till 59 and a half years old, we didn't talk about that, but they want you to hold on to these portfolios until retirement. It's not for short-term use. But as long as you meet all the requirements, all of the growth is tax-free. No federal, no state, no ifs, ands, or buts about it. You don't have to worry about, what kind of federal deficit is going on. You don't have to worry about the presidential administration in charge at that time. You don't have to worry about Illinois' issues. You paid your dues. You pay it up. Your account is truly all yours. Kind of cool.
Okay. How do people, how do you tell people which one to take between Roth and an IRA?
I think one of the biggest, not mistakes, but what I love to help people with is I like to catch them doing pre-tax. Most people are doing pre-tax because when you sign up in your 401k, that's the default. But they just didn't know there was an option or they don't understand it.
Or 457B.
Or 457, 401k, all that stuff.
Okay.
So people I don't think are really aware of what the Roth is. They don't really understand it, but I just love it. So for most people, I think Roth is a good idea because let me ask you, you work your whole career and one day you're going to retire and let's say you're 65 years old, you're making $150,000. Do you want to walk into retirement and start making $50,000? Do you want to go from 150 to 50 and have a big drop like that? No, right?
No, I don't.
You want to maintain your lifestyle.
I want to maintain my lifestyle that I have become accustomed to.
Exactly, right. So for most people, that's important. You don't want to retire and live on peanuts, right?
Yeah.
So if you're a good saver and you save your whole career, hopefully your income is the same in retirement, which means you're not going to be in a higher or lower bracket. It might be the same. So it's a question of, are taxes going to be higher or lower? Historically, at the current moment, we could argue that we're in a historically low tax bracket. Everyone hates paying taxes, but believe it or not, it's been much worse in our history. So
Really?
I'm kind of a fan of just pay the stupid taxes. Pay the stupid taxes, and then all of my money is my money. So I'm a big fan of Roth for almost everybody. Doesn't mean pre-tax is bad, but so where does pre-tax really win? Let's say you're mid-career, you're popping into those nasty 30% tax brackets. That's a good problem because you're a high income earner if that happens to you. But maybe you're like, I really hate paying these taxes. So maybe you go pre-tax and you can save some of those 30% taxes. That's a good idea. Or maybe your last 5 years of work. In your last 5 years of work, your income might have gotten so high and now we know for certain it's going to drop a little bit. And
Right.
It might save you some taxes. So if you're pretty close to retirement and we know you're in a 34% bracket, but let's say when we retire, we did the numbers and assuming tax law doesn't change, you'll pop back to 24. Then you might want to save taxes at 34% and then pull it back out at 24.
You know what's interesting? You mentioned overtime. And I remember when I used to work for the fire department, overtime was plentiful. And I always tell the younger group of guys that would come in, I'm like, overtime is not your salary. It's called overtime for a reason. Because you could easily get in debt thinking that, I'm working overtime, so I'm making hundreds of dollars every week. So you go out and buy $1,000, your new car, a new microwave, or something, significant. But it's interesting how all of a sudden overtime stops,
Right.
and now you're stuck with all those bills that you accumulated.
Right. I think I've seen overtime maybe 2 times or 1 times the regular salary, so it could be double income, right?
Yeah.
It's a big adjustment if you stop working overtime or if it's not plentiful.
Right.
as you said, right?
Yeah. Yeah.
You're right.
So, how much can someone contribute to IRA each year?
So the rules just changed for 2026. You can put 7,500 if you're under 50. Under 50 years old, you can put 7,500 into a IRA or Roth, and if you're over 50, you can do 8,600 per year. Kind of the first year was not straight $1,000 difference. It's that weird one now. But by the way, not everyone can put money into both of those accounts. It depends on your income.
Okay, so who's eligible to open up an IRA?
So if
And what's the income limit?
You know, I didn't print off the exact number, so forgive me if I'm wrong a little bit, right? But if you are a business owner or your employer does not offer a retirement plan, and your spouse, if you're married, does not have a retirement plan, then anybody can put money into a regular IRA, even if you make $1 million. You get to deduct it. So we got the numbers. But yeah, if you can make as much money as you want, and anybody can contribute to an IRA if you don't have a 401k available at your workplace, right? Or a retirement plan available. But if you do have a retirement plan at the workplace, then you're pretty limited. So if you have a 401 and you're married, your income they call it modified adjusted gross income, has to be below 123.
Okay.
So a pretty low bar.
123,000.
Right. If you don't have a 401k but your spouse does, then it's another weird number. Now it's 230, and these are for married. So, but if you're making $1 million a year, high numbers, then you can be excluded from the IRA, which is where you get the pre-tax. But it's kind of funny because anybody can still put money in the IRA, but if your income exceeds these limits, you don't get the deduction. But we put money into IRAs sometimes for backdoor Roth IRAs, which is a pretty cool trick if your income is really high, and we convert it back out. But we'll go there another time.
Now, does that also include people who have 457Bs or any other type of, not exactly a 401k, but another type of retirement fund?
Right. Any employer-sponsored retirement plan, then these new numbers come into play. Okay. And for the Roth IRA, by the way, we love the Roth. You can do the same limits, but for a married couple, it's irrelevant whether you have a 401 or something at work anyway, so it's just income-based. But the number is 230,000 modified adjusted, so if you're over that, you can't put money in a Roth direct. But that's where we do what's called a backdoor Roth.
Okay.
Kind of a cool trick.
What about a single person who's single or with kids or?
For the Roth?
Yeah.
So if you're single for the Roth, under 146,000 of income, you're fine.
Okay.
So if you're close, I always say consult your accountant, because if you do go over by the time you file taxes, you can fix it, but it's kind of a pain. So if you're close, then you can do this special trick, but if you're below the bar, go for it.
Now, I'm skipping because we're in tax season, or people are going to be doing their taxes. Can people, after they file their taxes, put money into a Roth?
It's an awesome question.
For the previous year?
Yep. So we're doing it right now through April 15th. Through the tax filing deadline, you can contribute for the year prior, which is a really cool idea. So if your bank accounts are growing, you got too much money in the bank, and you want to put it in a more tax-advantaged account, you can throw it in for the year prior. And I should mention quick, we were talking about IRAs and Roth. We love them, but make sure before you contribute to an IRA or Roth, make sure you're getting your company matches in your employer plan. Like, you want to get the free money first. So if there's money available, go get that, and then IRAs and Roth can be a great supplement.
Okay. I just had a notation in my head that I need to ask you a question once we're off this podcast.
Of course.
So what age can someone start a Roth or an IRA?
So it's a really low number, but the trick is you have to have income. You have to have a job. So you can open up an IRA or a Roth for your kids. If your kids are cutting grass down the street and they're making $2,000 a year, if they file taxes and they actually pay taxes on that, they can put up to their income into a Roth, which is pretty cool. Consult your accountant.
Now, what about, so like for instance, what I did, I gave my godchild money to start her Roth.
Mm-hmm, very nice.
Can you do that? can people do that
You
without having a job, without this, my godchild was 21 at the time, and I gave her $1,000 to start a Roth, and I told her after each time she filed taxes, make sure she puts money in.
Right.
I haven't followed up, but I'm like, you can lead a horse to water, but that's about it. That's all I could do.
And hopefully she has a statement, she gets to see it, and it gets her excited to keep doing it, right?
Yeah.
But no, if you're gifting to somebody, which is beautiful, if you're gifting, they do have to have a W-2 or some earned income to support the contribution. So I can't just gift my son money, because the Roth would be the best place to do it.
Right.
But because it's kind of too good to be true, remember, tax-free growth for life, as long as you take it at 59.5, you have to follow the rules to get it in.
Got it. We can't do racketeering.
No racketeering.
What age should someone realistically put money in a Roth if they're starting to, like, at 21, you're out of high school, you're starting your new job?
Probably like when I see it is probably a couple years out of college when they're starting their careers. But if their parents, like a lot of my clients, I get to meet the kids, while they're in college, and I love to do like free 101 investing 101. And man, I wish I started when I was right out of college.
Same
I did start
here.
my 401k out of college, but I wish I started pre-college.
Yeah.
Like just understanding stocks and things like that. So, but people are kind of like wealthier people are kind of gifting to their kids a little bit, helping them put money in their Roths pretty quickly out of college. But I think most people are using their 401s and not using IRAs or Roths, because you can put a lot of money in your 401 or 457 before you have to go to elsewhere.
Mm-hmm.
Today I can put $24,500 in my 401k, which is a big number. 100% of my pay up to that. So really, I don't have to consider a Roth unless I'm doing more than that. Because the 401k is very nice too.
Yeah. It was interesting when I first started looking at the stock reports and all this. Mm-hmm. And my mom used to take me downtown a lot. A lot of people don't know this, but Walgreens had a restaurant, had a diner.
I didn't know that.
Walgreens on State Street had a diner. And we used to go down there like maybe once a month, twice a month, and I would get a hamburger and fries. And it was interesting because you would see people come in suits and ties, and they would talk about stocks and bonds, just overhearing conversations. So at the time when I said, I'm going to invest, so me thinking at the time, when I get older, I'm going to invest. So I actually started buying CDs. And my dad was big on U.S. savings bonds. And that's how I purchased my first investment property, was with savings bonds and CDs. I use it as collateral.
Yep.
So do you see a lot of people doing that now, or no, you don't?
I would say not the younger clients, but definitely a lot of people have money in CDs, yes. There's especially now with all this political uncertainty and geopolitical stuff, people are nervous. They're always nervous though, but there is a lot of money in CDs and money markets, of course.
Okay.
But I don't think it's really like the best long-term growth.
Yeah.
But if you're trying to buy properties, it's a great place to hold your money, get some interest, and keep it liquid.
Okay. What are some of the tax advantages of IRAs?
So we kind of talked about the pre-tax on the IRA, and then when it comes out, it's fully taxable, and you're just subject to whatever the rates are. But Roth, as I mentioned, everything is tax-free as long as you wait till 59.5 to take it. But keep in mind with Roth, like I meet a lot of clients that have non-retirement accounts, like they got a Robinhood account or a Schwab account, and maybe they bought a fun stock like NVIDIA, and it quadrupled. But if you have the NVIDIA in the Roth, it's much different than having it in the brokerage account.
Oh, really?
The returns are the same, but how about this? So I have stocks in both, but if I have a stock in my Roth account, I can sell it any day of the week, and I'm not going to be taxed on it. I can sell it, I can buy it again, I can buy the dip. I'm not encouraging anyone to be day traders, but you get nervous, you want to sell it, great. There's no tax impact on it. It's not a liquid account. Your Roth is long-term, right? But if it's in your Robinhood or like a non-retirement Schwab, when you sell that stock, you have to think, oh shoot, did I hold it for more than a year or less than a year? Because that changes the taxation on it. If you make a $30,000 gain on a stock and you sell it in like 3 months, you're going to get hit with capital gains tax, which in Illinois there's a 5% tax plus the federal capital gains. So, you could lose 20%. In the Roth, I can sell it whenever I want, no taxes. Kind of cool. So we do kind of tell people, again, everyone's situation is different, but if you're going to have like professional, long-term, good growth stuff, it should really be in the Roth. You want that to double, triple, quadruple, and be tax-free for life.
Okay. What's happening if someone needs to withdraw money from a Roth? Like, let's say they need a down payment on a house, or how do they take money out right away?
Yeah, good question. By the way, for anyone listening, like if you have to come up with money pretty fast, I think it's always a good opportunity to talk to some advisor. Like, there are a lot of options. You don't have to just touch IRAs, right? But Roths are cool. So Roths say, if you start a Roth, you can always take your contributions out tax-free. But the growth, you have to wait till 59 and a half. So let's say over 10 years, I put in 15 grand and it grew to 40 grand. I can always get my 15 back, no penalty, no taxes. So it's pretty liquid, but that's not really like bucket number one you want to go after for a house. If you're saving for a house, you should probably save elsewhere in a more logical place for that. But you can also do like 401k loans. That's really cool. There's a lot of other ways to maybe get financing for it. But Roths are great. They do have special exceptions. I don't have the list in front of me, but like disabilities, I think first-time home buyer, I think it was a disability. So there's some ways to get money out.
Okay.
Educational expenses is one too. But for the IRA, if you want to get money out, none of that money's ever been taxed. It's all pre-tax because you got the break. So anytime you take money out of an IRA, you got to pay federal and or state if your state taxes it. But there is also a 10% penalty if those exceptions don't apply. So IRAs, again, are long-term plays. Hopefully you never have to tap it for short-term stuff.
Okay. When we talk about IRAs, and I didn't know this before you told me, what do you hold inside of our IRA? Like stocks, EFTs, mutual funds, what makes up?
You can really hold anything in there. You can hold, you can actually, we don't do it, but you can actually have a house in an IRA if you have a fancy accountant and it's really complicated, but there's ways to do that. But pretty much anything you can buy on Schwab or Robinhood, you can buy in a Roth IRA. You can do CDs, money markets, bonds, stocks, mutual funds, ETFs. Pretty much everything's available.
So you could put, and I'm just mentioning this out there, not for anybody to go do, but you could put in American Express stocks or the company.
Oh, sure.
And Nike or, Room and Board, other furniture stores, or anything that's on the stock market trading. You could put that inside of a IRA.
Yeah, and good point. It has to be like publicly traded stuff. It's hard to get access to the private markets, but anything publicly traded, you can usually get it somewhere.
Okay.
Yeah.
And you can make up your own IRA too, right?
Right. You can make your own investments. You can work with an advisor and have like a nice, solid, well-rounded portfolio too. Yeah.
Okay. How often should someone review their IRA?
Well, we do annual reviews with our clients, but probably most times not a lot's changing,
Yeah.
But like if you have big upcoming expenses, if you have like a new roof you got to do, or major medical expenses, or you're buying a new house or addition,
or
a car, or if there's job uncertainty, or if you just change jobs, like it's a good time to revisit all this stuff. But like if you think, I always tell my clients, like, hey, if you ever think you're going to need a big chunk of this money in the next 5 years, you got to let me know. But we're redoing reviews anyway. We're asking every year, of course. But like, because 5 years is a short time period, and that's probably gives you enough lead time to reposition stuff so that, a recession doesn't wipe out your profits.
I never will forget when I retired several many years ago, you said, don't go out and buy a car and a boat in the same year.
It's a lot to take on. Yeah.
Well, first of all, we'll never buy a boat. That's just, to me, that's just a muddy pit.
Yep. That's what they say, 100%.
Even boat owners sometimes say that.
Yep.
What is, so, for someone who's near retirement, where are IRA strategies can you help protect, stretch their money out longer?
So it's funny, like I can say a couple things about that. Some people retire at 65, and they say if you're retired, you should have a moderate portfolio. Moderate just means it's like, technically it's like 40% bonds, 60% stock stuff, and that's like, gives you some downside protection. Statistically, that might be the best type of portfolio to sustain like regular distributions all the time. Like you got to live off this income, so it should be the right portfolio to crank out as much income as they can handle and last like 25, 30 years, right? But that doesn't mean everyone who's 65 should have a moderate portfolio. I have a 90-year-old who one of her accounts is gun-ho aggressive. She's awesome. But every account is account specific, and I was like, what is the goal of this account? Oh, that account? That's for my kids. My grandkids, rather, right? Like, oh, okay. Do you think you're ever going to touch this money in the next 10 years? No way, because this person has significant pension. So there's no rule of thumb. You have to be moderate. Get some growth on it. Professional, logical growth. But the same goes for a lot of the police officers we work with, firefighters. Sometimes the pensions are so strong, it covers a lot of the cash flow they need. So they don't really, this retirement money, they have the 401ks are not really mission critical to their everyday life. But that doesn't mean it's useless. It might definitely come into play if there's like health events, if there's pension reform. So it all depends on like how much are you going to pull out of these accounts per year, what percentage of that, and like for how long, and that kind of drives like the type of portfolio you might have.
Okay, because sometimes people say they retire and all of a sudden they say, I'm going to redo my kitchen.
Right.
Or a couple years later, they'll say, oh, I need to pay down debt. Or a couple years later, they say, oh, I want to pay down my daughter's or son's school loans.
Right.
So,
I'm sorry, go ahead.
So you have to take that into account as well.
100%. And I've seen clients, close out a $200,000 401k for, like you said, an addition, or could be school or something, but they forgot that that's all taxable. So they got a tax bomb.
Yeah.
And it happens sometimes in the same year they're retiring, and they're retiring end of year, so they have a full year of income plus this tax bomb. So you can be smart about when you pull it out, how you pull it out.
Okay. So a couple years ago, the Chicago Sun-Times came out with an article, and I was reading it, and it said that if you put $1,000 into a Roth IRA at birth, that you would get just $1,000, no increases. You would get around $81,000 or $80,000 in return if you just did that for your kid or something at birth. I guess my question is, people should make a contribution to their Roth every year. That's my question to you.
Yeah, I think your number sounded kind of right. Like, if you start, I think Mark Cuban was saying something like that too. Give everyone $1,000 as a baby, and that could help really offset Social Security, the strain on the system, all that, right? But yeah, for anything, for all investments, you really should be saving consistently, continuously. It's all about how much you keep. It's not how much you have, it's how much of your dollars did you keep, because we can all spend it.
Right, exactly.
And putting it smartly away.
That's why it was interesting when I started investing. You were telling me, oh, you got to put more money in. And I said, okay, so from now on, I do my taxes. After my taxes, I see I get a return. I'm taking half that and I'm putting it into a Roth.
Which is awesome, yeah.
So that could potentially be up to over $1 million if you start early. For like, let's say you start at 21, or you had this Roth when you were born.
Mm-hmm.
So at 1 year old, you had a Roth of $1,000. Now you get 21, you're constantly putting money in. It could possibly go up to over.
Oh yeah, your investment has to get several $1 million, I'm sure.
Yeah.
If you're funding it, if you're maxing out every year and pumping a lot of money into it, yeah. And I think we brought this up on the last webinar, but there's so much to be said for starting early. So there's some like rough numbers that are like, if you start saving right away at 21 years old and you save only for 20 years and then you never can afford to save anymore.
Yeah.
Well, then if your friend starts saving when you stopped, so they missed the whole first 20 years that you were saving, they were spending, and now they start saving the same amount you were saving, they're never going to catch you. Even if they save like, I think the number was like, you save 20 years and they have to save 40 years and they won't catch you. It's all about how much time that money has sat in the market.
Really?
Yeah.
Is there I know we said this before, but I'm just going to go back because my short-term memory is shot. How much does it take to start a Roth?
You can start with $10, $5, whatever you want. Some companies might have minimums, but it's very little. There's even like, I think Acorns is that one app where you swipe your credit card. I don't use this, but you swipe your credit card and let's say the bill was $39.94. They take that 6 cents to round up and they put it in an investment account. I don't think they do Roth, but I think that'd be cool if they did. Like if you started saving that towards a Roth every year, like just even pennies, like anything helps.
That's interesting.
Yeah. You don't want to starve and have such a not fun life because you're saving every dollar in retirement. Because people also don't live long retirements sometimes.
Right, exactly.
So it's all about balance, by the way.
Yes, exactly. Between pizza and chicken. There you go.
Right, exactly.
There's always a balance.
You got to make choices.
Exactly. All right, we're going to wrap this up. Anything you want to say or give your information, or where can people find you, or any type of information you want to give towards the Roth or anything?
I think we covered a lot of good stuff today, but I just thank you for having me again today. I appreciate it. My name is Bryant Taylor. I'm a certified financial planner. I'm at LPL Financial. Our company is Integrated Financial Concepts. We're here in Chicago. We're here to help.
All right. Thanks, Brian. I'll talk to you guys later. And that's it for All About Nothing.